Now, people all the time tell you, don't invest in risky assets. But I'm here to tell you that you can still be in risky assets and make a profit. In this video, I'm going to outline 3 things to look at when you are in a risky investment. And at the end, I'm going to show you how I didn't look at those 3 things and how I lost $20,000. So let's jump right into it. First thing is first is market cycle. Where are we right now in the market cycle? We are in a bear market. What does that mean? Things are like this, tanking all the way down. And you don't want to be in what they call catching a falling knife. Now, they say that for any particular asset. So as it's going down, if it's Bitcoin, you don't want to jump in there and say, hey, look, this is the low. I'm going to get in and it's going to bounce right back. So that's usually not a winning strategy when it's short term. So you got to look at what the cycle is like. In a bull market, when things are hot, you can be in riskier assets because there's a better chance that the entire market is going to lift. And so your risky asset is also going to lift. But in this type of cycle, what are the chances that your particular project is going to outshine everything else that's tanking? So you have to keep that in mind about where you are in a market cycle. Number 2 is you got to look at timeline. And when I say timeline, I mean the timeline of the project itself. So if a project is just newly created, you have some leeway for when things could go south. And what do I mean by that? Well, typically a project can last anywhere from, I would say the sweet spot is kind of 3 to 6 months. It's really where it is. Now, you may be an investment that you think is perfectly safe and it turns out to be risky. So this will also mitigate that type of scenario. So if you're coming in at the tail end and now it's month 6, month 7, month 8, and it's a project that is kind of shaky or people don't really know much about it, the chances of you actually making something out of that are slim to none. So the timeline of the project itself really matters in this space. And number 3 is how much money are you willing to put in? One of the biggest mistakes, and which I'm going to show the project that I made this mistake in, is actually dollar cost averaging into a risky investment. Now, dollar cost averaging itself is a great method, a great strategy to use when it's long-term investments. I use this for Bitcoin and ETH. It's one of the things that when you have severe conviction over a certain project, it's the greatest strategy to employ. But when you're in something that's, I don't know if it's going to do well, or I'm in this for the short term, you don't want to be dollar cost averaging because that means you're sinking money into something over a period of time that has a less likely chance or less likelihood of coming back to you. Just even your principal, forget the profit, just what you're getting back. So you don't want to employ that strategy. You also want to make sure that the amount that you put in, the principal amount, is small enough that if it goes to 0, which this is risky, so there's a higher chance that happens, is that you sleep okay at night. You don't want to financially ruin yourself. And the biggest problem, which even happened to me, is that you start to calculate, well, if I put in this much and this is the return expected, this is what I'll end up having. And the greed, right? The most common, one of the most common human emotions is greed. And so that drives everything that's happening here. And especially when you come in, I would say kind of the mid to tail end, is you see the history of the project and you start to project out. And you say, well, now that I'm in here, if I get 6 to 9 months or 12 months, this is what's going to look like in terms of my return. And so picking up that calculator or being on your computer or laptop or device, you start to play all these scenarios, these what ifs. And then you start to be like, okay, well, if I did this, if I put in 5,000, imagine I put in 10,000. Imagine I put in 15,000. And imagine I put in 20,000. And so the numbers start to circulate in your head. And next thing you know, you're in a position that you had no intentions of being in. And there's a bigger risk for that. And now you can't sleep at night. So those 3 things really can even allow you to be profitable within a risky investment. So the recap there is market cycle. Where are you? Is it a good market? Is it a bad market? Second thing is you want to put in timeline. not even just your own timeline. That's part of it. Are you in for the short term, medium term, long term? And if it's risky, you should be in for the short term, right? And then, but more importantly than that is the timeline of the project itself. And then lastly is principal. How much are you willing to put in? And make sure that you don't actually start to put more than you wanted to over a period of time so that it bites you in the butt later. All right, so those are the three things. And I'm going to actually cover now, as I mentioned, the project that got me. All right. And it's still going. So, I mean, it's not entirely out of the realm of possibility that there could be some return on it at some point. And maybe you guys are familiar with this project. Okay. So this project is called Phoenix Community Capital. And it was a project that's built on the FIRE token. You created what's called a nest. I won't get into all the nitty gritty, but if you have a nest, the nest is going to, give you a yield. I think it was, you're making like 2.25% per day. Yeah, per day. So it would accumulate in your nest. You could never remove the nest, but you would get yield on top of the nest. Okay. And the nest was built off of the FIRE token, which actually came through Avalanche's token itself. So you would buy Avalanche, and then you would have to convert that into FIRE tokens. And then with the FIRE tokens, you would actually have to buy the nest itself, which would then give you yield. Okay. So the more nest you have, the more yield you would have over time. And that yield was paid out in FIRE tokens. And then you could actually take the yield off the platform, convert it to USDC or Avalanche or whatever. And that was yours essentially. Okay. So the history of this actually started when a colleague of mine told me about this probably in December of 2021, December of 2021. And I wrote it off. I said, absolutely not. 2.25% a day, ridiculous yield. I'm not down with it. Not happening. So, all the common sense reasons, right? And so, but the market was hot then. And so as she showed me in November, and now I'm looking at, she's telling me, look, they airdropped, a nest for free, which one nest at that time was probably around $3,000 in total, because you needed 10 FIRE tokens to create one nest. So the price of FIRE was up, price of Avalanche was up, like everything was up. And so now I'm watching this. Now the market did turn mid-November, end of November, but it was coming down slowly. So there's still December, it's January, it's February, it's March, and I think April or May. Right? April or May, we all know the market's not doing well. It's not like what had happened was the market had taken a turn for the worse in, I believe it was February. And then it had a little bit of a bump then. It started to reverse. And so now I'm looking at it, I'm like, it's still doing well. I mean, at its peak, FIRE was about $700 US dollars. And then when I saw it, it was still ranging between $200 and $250 a FIRE. Okay. And so what ended up happening is now I'm looking at it, I'm like, look, it's surviving. And the basis of this project was actually the reason why they called it Phoenix was it rose from the ashes of a previous project that was rug pulled. Okay. That was rug pulled. And the founders fully doxed, meaning they were fully transparent on who they are and how they operate. They had weekly AMAs. They were involved in their community. They even went and did guest emceeing at award shows, crypto award shows. Like they were legit. It wasn't like you didn't know who they were and they were hiding. It was fully legit. So that added even more confidence to what I was thinking, because I'm looking now, I'm like, I've heard about this project for 6 months. Remember the timeline I said, you want to be at the sweet spot is before 6 months. So it had been around six months or so. And I'm like, you know what? Let me go in it. Let me try a little bit and put it in. And I'm seeing now the mechanics. I'm getting the daily yield. I actually withdrew a bunch after a while. So I'm seeing real time that it's not like it's locked up. They're still doing their AMAs. They're still on YouTube. They're still doing all these things. Must be worthwhile, right? There are people that have been in for the last, probably even from the previous project. So a year, maybe just less than a year. So all that's getting some confidence, right? These guys are at the forefront. They're not hiding. They're answering everyone's questions and things are going smoothly. But what happened is the market continued, as we know, to sour. And as that continued to happen, these guys who were supposed to invest in non-crypto related projects, real estate or whatnot, and then take those rewards and pass it on to those of us who invested and created nests, it wasn't working. It wasn't making sense. And they were also being like an incubator. So projects would come through them, and these guys would take a percentage of the profits of that startup, and which would then entail more yield to the investors. That's what was happening, or supposed to be happening. Things started to go. I mean, the FIRE token was getting crushed, just like everything else in the market. So as I mentioned, it was $700 at one point. Then it went down to, where I came in was probably around 200 to 250. And then it just continued to go down and down. And here's what I talked about: do not dollar cost average, DCA. So what I'm seeing, I haven't seen it go dip below 200, and I've been watching this for what, 5 months? I have never seen it. It's a good time to buy. So it goes down to 150. It's hovering around 165, 170, 130. And then things just continue down, 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 down we went. And I mean, last I saw, I think it was sitting around $2-3. And the founders had had enough. They had made their bank. They left. They brought in somebody new to run the company. That person, I think, left. And now we have somebody else who's new. I don't know if it's the same person or not. So all kinds of weird things were happening. It wasn't run as a legitimate business. But the point here is that the onus was not on them. The onus was on us as investors to look at this and figure things out. So that's why I wanted to share here. That's why I wanted to share those three things. Those were the three mistakes I made. One, I did not recognize or figure that the market cycle was going to be as dramatic as it was, and over a length of period of time as it became, right? Everyone was getting hit. Stock market's getting hit. No one was prepared for that. While people say that they predicted it, their actions did not. Okay. Many were not prepared. And so that factored in. And then what happens is these founders who've been working on things for so long have a bunch of the assets themselves and have either cashed out or sitting out. They want out. They want to go do their other projects from the money that they've made previously, and they go, right? So the market cycle was one, for sure. The timeline was horrible. Coming in at the 6-month mark for something that is risky, it doesn't make any sense, right? Or at least tying that into the principal for the amount that I put in didn't make sense. And so timeline, okay, that sucks. Principal, I started off with probably around $5,000, around there, which was completely fine if I just left it there. But I continued to add. And next thing you know, it's 20 grand. Now, all told, because I did withdraw some, was probably around 15, but it's somewhere in there between 15 and 20K. Gone, because I did not adhere to the three things that I told you about. Anyone can sit back and be like, well, it's pretty obvious this was a scam, but the way things were run, it was supposed to be a proper business and was shown to be that, at least externally. When new management came in, we found out that internally, things were not run like that. So it's one of those things. They were having their weekly AMAs. It's just one of those things that you learn. And so you don't take those experiences and project them onto future projects. What you do is you take the learnings from there. And those three things that I outlined, market, timeline, and principle, that will save you so much heartache, so much headache, financial pain, but it'll also allow you to be profitable even in risky investments. Had I done that and recognized the timeline, I could have gotten out earlier and made a good chunk of change. I will say this, at the very least, you want to get your principal back. So whatever you invest in, if it was 5K, 10K, whatever, you want to make sure that you're able to cover at least that, and then everything else is bonus. It's gravy, right? You let it ride. So I hope you guys found some value there. I don't think you should still avoid risky investments, because the very truth of it, the harsh truth, is that in this space, unless you're in Bitcoin and ETH and maybe some of the other top 10 projects out there, many things are going to be risky, if not all of them. So the best thing you can do is understand the timing of it, the market, and how much you're willing to put in, and try and get your principal back as fast as you can. And then everything else is profits, and that you can deal with in a very different way. Check out all the videos about crypto investing, things that I've learned, did well with, and didn't, all from this playlist right here.